You're about to realize something. There's a lot of fine print that the insurance industry wants you to miss when it comes to how they make their profit, and it's becoming harder to hide that by the passing year. The conversation you're about to watch between Dave Ramsey and a whole life insurance broker was almost on the edge of becoming heated, with Dave revealing the financial crevices in whole life insurance that render it a far worse option for the average American than something like a term insurance. And that's a perfect place for me to dive into why that rings true in the context of some statistics. Obviously, this is not financial advice, but subscribe to the channel, take a look at this before I tell you more about it.
Number one, you have said on your website that term insurance is the best and the only kind of product people should buy in all instances when they need life insurance. And what I can tell you is that we do not recommend whole life insurance across the boards. We recommend life insurance situationally. There's no two needs, no two situations that are pervasively similar. Okay? Can you hear me all right?
Yeah, I'm hearing you. Yeah.
Okay. Number two, the cash value that you've talked about is
Wait a minute, did you want me to address that one first?
It's up to you.
Okay.
If you'd like to, I'll be happy to do it one at a time.
Well, you're an insurance agent, obviously, and I disagree when you say there are no two instances that are the same. There are basic principles of mathematics and basic principles of personal finance that are always the same. For instance, I would tell you there is never a time that you would use a credit card.
Mm-hmm.
You can't say that you can't convince me that there's certain times you should use a credit card. They suck. They're a bad product. They don't work. And I think the same thing's true of whole life.
Let me take you a level deeper here and look at the mathematics that Dave Ramsey just spoke about. That's because it's the unchanging rules of math that will decide whether you're getting a good product. Nearly 2/3 of all life insurance products sold in the United States are whole life insurance, and that's despite the fact that their premiums are as much as 1,700% more expensive than term insurance. For example, the average term life insurance premium for a healthy 40-year-old male in America with $250,000 in a 30-year plan is about $360,000 a year. If that same person were to instead take out a whole life insurance plan instead, they'd be paying more than $3,500 a year. Every person before they buy life insurance needs to ask one important question: what are they getting by paying over 10 times as much money? Well, it's not just the idea that they're covered for their whole life, but a rather ominous financial and emotional trick that insurance companies use. That's because most of the additional money you pay goes to a savings plan of sorts, growing at a meager 1.5% a year on average, which is even far below the inflation rate. It's that cash value segment of the plan that you can borrow against in your life, but immediately goes to the insurance company as profit once you pass away, because your beneficiaries only receive the smaller pool of money called passed away benefit. It's in that manner that an insurance plan acts like it can be a savings and investment plan all in one, and yet it largely only benefits the insurance company in the end. That's also why insurance brokers also receive massive commissions for getting more people on board whole life insurance, sometimes even receiving 50 to 100% of a customer's first year premium. That's not an accident, because if the insurance company and the brokers are all getting richer off a plan while the money ultimately comes from the customer, you need to ask why before you sign your name on the contract.
Number two, there seems to be some question about the cash value of a life insurance policy as being a bad investment. And I won't get into the issue of performance, but I think the big thing that you need to realize is this: the cash value is not there because insurance companies are creating a standard of return or investment that is deemed to be poor or is deemed to be immovable. The cash value
then why would you do it?
Policy is there. It's a function of law. It involves.
So why would you put extra money into a policy to create cash value if the cash value has no standard of excellence at all on the rate of return?
Well, you didn't let me finish. Those policies historically get better as they get older. Okay? The cash value of a life insurance policy is a function of state law. It's a function of statutory reserves.
Sure.
And also, from an actuarial standpoint, it's used to keep premiums level indefinitely. Why do you think term insurance is so cheap? Because term insurance does not have or maintain a legal reserve affixed to it.
Well, sure it does. They have to have cash reserves to support. Otherwise, the state won't license the term insurance company.
The thing is, it's not just possible to justify the existence of something like a cash value by simply chalking it to the idea that the insurance company needs to keep a reserve. term insurance still functions without it, which means a large part of having a large pool of cash in the insurance company's coffers growing at a snail's pace is the incentive and make profit for the insurance company at large. When asked about why they are even getting a life insurance policy of any kind, the largest demographic of people in America respond that it's meant to give their family and children enough financial security after they pass away. Two major differences between whole life insurance and term insurance make you see which one an average American would be better off with. The premiums they pay up front for decades of their life, which are over 10 times higher in whole life insurance, and then the pool of cash value that an insurance company simply keeps as profit for itself after the person passes away, giving out only a smaller segment of the benefit. When you look at these facts in the big picture, coupled with how much insurance companies need to incentivize their agents to go out and sell whole life insurance products, you realize where Dave Ramsey's aversion to it is coming from.
If you die, you get paid with term insurance. Your beneficiary gets paid. Pretty simple formula. If you die with whole life insurance, your beneficiary gets paid only the face amount after you've paid 20 times more for the policy.
I can refute that very easily.
Well, you can't.
If a policy is arranged properly, a person can receive not just the face amount of the policy, but in addition, they can receive the value of the cash account.
No, they can't. Not unless not unless it's an AB universal, in which case you paid more for it to start with.
No, you do not. That is not true.
Are you talking about paid up additions?
Pardon me?
Are you talking about paid up additions?
No, I'm not talking about paid up additions. There is did you ever have something called the fifth dividend option?
Sure.
Okay.
Absolutely.
What is it?
Well, absolutely. The bottom line is, at the end of the day, the people don't get the cash value. You pay 20 times more, and the cash value is not added on. Now, I mean, you can look at every major whole life company that's out there, and you tell me they get their cash values. They don't get them.
That is not the only angle of what makes cash value a questionable component, because if you borrow money from that pool of money at any point in your life, you'd be paying interest to the insurance company for loaning your own money that you've spent 10 times more expensive premiums in paying for over years. And no matter which way you look at it, the idea that insurance companies can pretend to have a savings component or an investment component makes no sense for the customer, but a lot of sense for the insurance company who stands to gain from it. They don't adjust for inflation or purchasing power over the decades and grow at 1.5%, which is at least 6 times slower than if you put the money into an actual investment vehicle like an S&P 500 index fund. Too often insurance companies sell the cash value components as some idea of BYOB or be your own bank, so you supposedly don't have to go to a traditional bank if you need to borrow money over the course of your life. But what they leave out is that the bank is not the customer, but the insurance company that takes on that role.
It really is, because it's garbage, Russ.
From very prestigious business schools, I think they know a little bit more than the layperson.
Well, they may or they may not, but the bottom line is that at the end of the day, dude, it is the payday lender of the middle class. It's a horrid product. When you pay 20 times more for the same amount of coverage to build up a cash value that you never receive, because when you die, they pay the face amount, Russ.
They pay and can pay, and I will refute that in any way.
You can refute it all you want, but you're wrong.
I know I'm right. I've been doing this.
So I can argue with you like I can argue with a brick for the rest of my life, and the brick's still going to be a brick. And so when you and I finish talking, you'll still be a whole life agent, and I'll still be right.
Dave Ramsey's frustration is understandable because insurance premiums for whole life plans are becoming a major financial bane to middle-class Americans with the rampant rise of inflation and living costs. And it's starting to look like something that too many Americans seem to have signed on for their lives without rigorously crunching the numbers on who such a plan really benefits in the end. Let me know in the comments what you think about this, because I believe this is one of those areas where insurance companies stand to gain directly from the naivete of the people that they want as their customers.